Welcome to the Times of Industry show. This is Lior Gantz, and I'm glad you could join us today. During the month of June, we've interviewed many wonderful guests from the cryptocurrency ecosystem, the natural resource sector, the marijuana industry, and today we're joined by Peter Hug of Kitco.com. Peter is a veteran of the mining sector and a first-time guest. We'll be speaking mostly about different business models within the sector, important developments, keys to success, and the current sentiment. So sit back, relax, and ease into this. Peter, how are you today?
I'm doing well, Lior. Thank you.
I'm glad you can join us. I want to ask you, how is the retail investor, what's going on with retail investors right now in the resource sector? As the retail investor about fed up with the sector at the moment? We've had sideways and downward cycle since August of 2016. Most people don't short any of the ETFs as a hedge, so being net long, they see their portfolios in the red. Daily volume for the juniors is weak. Are we close to a bottom in your opinion?
On the equity side of the picture, I tend to stay with the primary producers that have proven reserves and have cash flow positive balance sheets. The juniors, the odd time I'll take a shot, but quite frankly, I've been in the business, in the metals business, since 1973, and on the equity side, juniors, sort of the rule of thumb is you buy 10. It'll go to zero, and you might get a double and a triple out of one, and maybe a home run out of the 10th. They're extremely speculative, and when you have a precious metals market that is generally in an upsurge, such as 2008, 2011, pretty much the water lifts all boats, and even the juniors that haven't made any money and don't even have prospects for production coming on market for 5 years also benefit. In a climate where the market is more, let's say, balanced or just more neutral, you're going to have issues with the juniors because they're cash flow negative. They have to keep coming to the market to raise capital, and in an environment where the metals aren't sparkling, that's difficult. So that's why you're seeing the mining sector, especially on the junior side, lagging the actual bullion market.
So either stick to the larger companies with proven reserves, or go for the ultra quality junior companies. Are the mega cap companies right now healthy in your estimate? Are they profitable? I'm talking industrial metals and precious metals.
Again, it's case by case. If you're talking in the gold sector. Barrick and Newmont are cash flow positive. They've got proven reserves, and their cost of production is under $1,000. So at these levels, they're still making money. On the precious metals side, generally, just as an investment class, whether you're buying mining shares, ETFs, or physical precious metals, which is what Kitco deals in, gold isn't something that is any different than let's say IBM stock. There are times, and there are either for geopolitical reasons, inflationary reasons, or just general unrest or supply and demand issues, where gold and silver are a good investment in the sense that you might want to calibrate a higher percentage of your portfolio towards those two asset classes. And there are times when it's a lousy investment. It's really what the psychology is of why you're owning gold. And if we're talking on the physical side, there's really two psychologies as to why people invest in the gold market. And one is, there's a relatively large percentage. Now in numbers, it's probably 10 or 20%, but relatively large in the psychology that, especially in the U.S., where American investors do believe or have bought into the story that the U.S. government is going to ban gold ownership, and the system is going to implode, and there's going to be financial Armageddon. And it is absolutely paramount that you buy gold in physical form, and don't trust anyone, and store it at home. And when apocalypse arrives, then you'll have something to barter with. without commenting on that psychology, that group of investors, it really doesn't matter to them whether they're buying gold at $1,200 or $1,500 or $1,000 an ounce. It's more an insurance policy against an apocalyptic event, and they believe that when that happens, gold will be at $5,000 or $10,000 or $20,000 an ounce. That aside, if we look at sort of what I would call the more conservative investor that looks at precious metals, again, either in ETFs, mutual funds, gold mining shares, and or physical metal, as a percentage of their portfolio, having been around since 73, sort of the standard line that comes out of all the talking heads is you should own X, whatever that number is, 5%, 10%, 15% of your portfolio in gold, in case your other asset classes experience a financial issue such as we experienced in 2008 when gold moved from $600 to $1,925, tripled in value in the space of 3 years and culminated at a 1925 top in 2011. But what these talking heads fail to tell investors is that you've got to calibrate your portfolio, and it doesn't matter whether gold's in it or not. Generally, if you hold a portfolio, you don't just sit on it and just ignore it. You look at it, and sometimes you need to tweak it. And generally, my rule of thumb is you should look at it a minimum of twice a year. And if you're looking at gold now, let's say as an insurance position, and let's say you have 10% of your portfolio allocated towards gold. And let's assume you bought that gold in 2008 when it was at whatever, $600, $700 an ounce. In 2011 at 1925, I could almost guarantee you that 10% position that you bought in gold was probably now more representative of 18 to 22% of your total portfolio because of the increase in the value of your gold position. If you're using gold as a hedge, then you need to sell that 12% and bring your balance back down to 10. Vice versa, had you chased the market and not gotten into the gold market until 2011, and we're unfortunate enough to buy it at the top at 1925, when you look at it today at 1,200, I would suspect that 10% is no longer 10%. It's more probably 4 or 5% of your portfolio. So in that context, you have to buy another 5%. So what that does then, it keeps you balanced from an insurance position at 10% at all times, but it also allows you to lighten up on your defensive position as the market goes higher, and reduce and increase your defensive position as the market goes lower, and that keeps it balanced. So then people say to me, well, gold was at $1,300, or let's say $1,350 August of 2016. It's now trading at $1,250. I'm out $100. Well, in percentage terms, give or take, that's about 8%. So you've lost 8% on a 10% investment. So you're down a little under 1%. You're down about 0.8% of the value of your hedge, which is the gold. But the balance of your portfolio, the other 90%, has gone up something like 15% in the same period. So it really depends on the psychology of why you're buying gold. If you're looking at it purely from a capital gains perspective, and you want to trade it like you would trade an Apple stock, then you've got to be a bit more in tune with what's happening in the market, i.e. what the technicals look like, what the short and long term, or at least the medium term range looks like, and then you can make some decisions based on that, and also maybe just have a small position in case something crazy happens, like with North Korea, or something happens with the Brexit vote in England, or something happens with the U.S. equity market that is fully priced at current levels. And what if that drops 20%? Do fund managers then allocate out of equities into gold? And maybe you want to have some gold in that scenario. So it's difficult to answer the question as a yes or no, or this is what you should do. It really depends on the psychology of why you're in the market in the first place.
Why are we seeing such low merger activities?
In the mining side, nobody's got the cash. Nobody's got the cash, and a lot of these properties, especially in the junior space, I mean, they're adjacent to a good property, but they don't have anything in the ground yet. And, it's one thing discovering you've got gold on your land. And by the time you get that out of the ground and delivered and actually able to realize on the intrinsic value of your holding, it could take anywhere from 3 to 7 years.
What makes you choose to invest with a specific company, and what's your time horizon?
Basically I look at the caliber of the management. Now, if we're talking equities, I'm guessing that's what your question is referring to here. I look at the quality of the management, the experience the management has, and I look for positive cash flow. I look for proven reserves, and I want to see that they're already at or very close to production. I don't want to buy a piece of property that might go into production 3 or 5 years from now.
So you basically like late stage development companies that have proven...
Yeah, again, it also depends on your age, Lior. I mean, I'm 65 years old, so I'm going to be a little bit more cautious on taking a flyer. When I was in my 20s and 30s, when I still had 30, 40 years of earning power in front of me, I took all kinds of flyers. So that's also a consideration. An investment advisors, when you take the Canadian or securities course, like I did back in the 80s, I mean, one of the principal things you learn as an investment advisor is you need to look at the risk tolerance of your client, the capital capability of your client, but also the age. A 65 or a 70-year-old individual shouldn't be buying a junior mining share on hopes it's going to triple and not be able to afford losing all of their investment. Whereas a 20-year-old, 25-year-old, drops into $2,000 or $5,000 or $10,000. Yeah, he loses it all. Yeah, it's going to hurt, and he's going to be angry. But it's more than likely he's going to be able to make that back up because he's got his earning years in front of him. So again, these are not yes or no answers. It's you have to look at the overall picture.
Peter, speaking with companies and other investors, are the juniors having issues raising funds, or is there a demand from insiders to participate in financings right now?
I think some of the juniors are having small issues. We're not at the stage yet because gold really, is still at $1,250 is still at a level where most mines and mines that are coming on stream can make money. When gold dropped in 2015 down to 1,040, it was a totally different story. I mean, most of the junior mines were not able to raise any capital. Nobody wanted to touch them. So I don't think the situation is as bad right now. And there are some geopolitical events and some fundamental events that could turn this gold market around very quickly on the upside. It looks, the fact that gold is holding at $1,250. Some people say, well, that's, pretty boring. Gold's at $1,250, big deal. Well, it pretty much is a big deal. You've got the Federal Reserve raising interest rates. You've got an equity market at an all-time high. You've got yields on fixed income still at relatively historic low levels. I mean, you'd be lucky to get 1% on money market rates right now. And so, in all that context, you would think, well, why would you own gold at all? I mean, why isn't gold down at $1,000 an ounce or $800 an ounce? Why haven't investors just literally blown it out and gotten rid of it? And it's because there's an underlying unease in the market. And you can see that with the fund managers. They're still fully engaged in the ETFs. There is fluctuations as the price moves, but generally ETF volumes and stockpiles have increased over the past 6 months, not decreased. So there is just this underlying nervousness in the market. You look at the U.S. equity market fully priced in on the basis of Trump passing every single one of his promises, which means full tax reform, repatriation of offshore monies from corporations, a much better healthcare system, employment is at an all-time high. Everything looks okay. It looks like everything should work out. But then why is gold not suffering? And so that indicates to me that there is some anxiety and some unease about whether or not Trump is going to be able to push through his agenda. and then whether or not the Federal Reserve will continue raising interest rates. If the economy starts to backtrack and slow down, the Fed may go the other way and start to ease again on interest rates, which again would be positive for the metals. So, I'm not seeing a capitulation in the metals here, and that indicates to me that there's still some angst in the overall market, which is supporting the precious metals market.
If individuals want to seriously succeed in this sector and get involved with financings, how do you suggest for a guy listening or a girl listening to this interview, starting from scratch, how do you suggest they get closer to the plate and become part of the financings?
Well, you really, first of all, got to do your homework. But secondly, you need a good resource broker that can guide you through the process and hopefully get you in on the ground floor. That tends not to happen. I mean, most of the financing for juniors is done on a sophisticated investor basis, where your minimum investment is $150,000. Where they expect that the client is knowledgeable enough to understand the risks. Most of these very, very small juniors don't go out with full prospectus, which opens it up to the full retail market. Again, you need somebody that you have a comfort level with, somebody that manages the junior mine portfolios, and look at their track record, and not only their track record between 08 and 11, where you pretty much had to be brainless not to make money. The market was just on a straight upward path. But in markets that are slow, markets like 2015, where the market has come back down, look at the loss in the index, compare it to the performance of the manager, and if he's outperformed the index in a down market, then he's likely to outperform in an up market. Again, not an easy yes or no answer. It's really a matter of just searching and finding people that you have some comfort level with. One of the things, again, very preliminary thing you could do is you could go on Kitco.com, and we provide daily commentary on a variety of markets, but most specifically on the metals market. And there are sections within that website that speak about mines, junior mines. They have news releases on junior mines that are listed on the Vancouver exchanges, and just get used to the information and look at some of the analysts that are reporting and commenting on them, and then sort of watch if this analyst says, look, I really like ABC. Watch ABC for a bit and just see what the guy's call is like, and once you develop this kind of comfort level that you sort of like his or her call on a percentage basis, and again, he's never going to be 100% right, but on a percentage basis, then you can reach out and determine whether or not they either manage money on a private basis or they could recommend a broker that would be able to execute on some of these stocks.
Is Chinese demand for industrial metals showing any signs of improvement?
Not yet. My main gauge on that is copper, and copper, they're not off-taking copper right now. They've backed away from the copper market. The Chinese investor, though, the retail investor, China Hong Kong, has been very aggressive in the precious metals market. They're aggressive buyers of physical gold and silver at these levels, as well as the Europeans. Again, from a North American perspective, sometimes you get myopic. You sit there and say, well, against the U.S. dollar, gold hasn't done anything. It's at $12.50. But, in Canadian dollar terms over the past 5 years, gold is almost at the same high it was at in 2011, because the Canadian dollar has dropped 35% against the U.S. dollar. The euro has also dropped some 20-odd% against the U.S. dollar, which, when converted gold into euro terms, in their terms, gold is up. The Chinese have just been continuous buyers on any dips. Anytime gold approaches $1,200, there's aggressive buying by the Chinese. Anytime silver approaches the low 16s, there's aggressive buying by the Chinese. The Russians have started to accumulate gold as well at these levels. So there are pockets in the world where gold and silver buying is continuing at a fairly brisk pace. In the United States, there has been so much product that has been delivered to the market between 2007 and 2012. We're talking hundreds of millions of ounces of silver and gold in investment-sized bars. Well, silver anyway, not gold, but gold maybe in the tens of millions that have been delivered into the U.S. market in investment-sized bars. So the market is relatively saturated with product. So what investors are now looking for from a U.S. perspective is they're looking for a price breakout. So either a price breakout above 1,300 or below 1,200. And in silver, a price break below 16 or above 19. And if we get a break out of those levels, I think you'll get investor engagement again in the markets.
Peter, your take on oil prices going forward?
You hear about this stuff from OPEC and all that. I think they've become a non-player. Obviously, they still produce a significant amount of world oil, but the swing producer right now is the U.S., the fracking companies can make money at $42. They can make money at $38, and if they don't, they can shut their wells off and their operations off. And then, if oil pops back up to $45, they can turn them on. They can turn these things on, on a dime. So the U.S. has become the swing producer. Right now, the global economies are still struggling for growth. That's why I think you still see the Eurozone interest rates near zero, Japanese rates at negative, and you're not seeing this global growth yet, the engine yet picking up. It could be soon, but right now it's still relatively anemic. So you're not getting the demand, and there's a huge surplus of oil on the market, and without the demand increasing because of higher growth, I suspect that the path of least resistance from oil, even at the 42, 43 level, where it is right now, is down, possibly into the mid-30s. Not discounting that you're not going to get a bounce here to 45 or 46, but I think the overall trend short term is probably still lower.
Peter, it looks like your thesis on precious metals right now is that creating an optionality play company where they accumulate cheap, distressed assets that have proven reserves and sit on them instead of depleting their mines when gold is still relatively cheap compared to what it could be after breaking out 1,300 is a relatively sophisticated play right now, because you're sitting on cash. You're not using up your treasury. You don't have to go to the market too much. You accumulate distressed properties from other companies that have failed to manage them correctly, and it looks like that could be something that is very profitable.
It is, but again, most of the people that are in the precious metals industry now, by that I mean the dealers that sell physical precious metals, I would say about 80-90% of them are sort of new to the game. By new to the game, I mean they entered the game at the perfectly right time when you didn't even have to learn how to walk and chew gum at the same time back in 2007, 2008. And the first 3 years they were making a lot of money, and they thought, boy, this is just like having my own printing press. And now the market's been on a downward slide since 2011 with the odd sort of bump up. But from 1925, it dropped all the way down to 2015 and to 1,040. Then it went up to 1,380. Then it went all the way back down to 1,150, and now we're at 1,250. These dealers think that this is temporary, and it possibly is temporary. But I have been in this market since '73, and I've seen these markets go sideways and be absolutely boring for periods of over 10 years. Between 92 and 2002, the gold price moved a total of $40 in a range. And it was down at 350 odd. There are, when these markets capitulate and turn over, they can stay dull and down for longer than most people have the patience to wait.
Interesting. Peter, thank you very much for taking the time today.
Thanks, Lior. I appreciate it. It was a pleasure being here.